Living off dividends involves relying on a portfolio that generates a passive income stream capable of covering one's expenses indefinitely. The concept eliminates the need to work for a paycheck or worry about the fluctuating value of the portfolio, as long as dividends continue to be received. Dividend stocks and funds held in one's investments account consistently provide recurring dividend payments. These payments are automatically deposited into the brokerage account throughout the year, without any effort required from the investor. Once received, the cash can be transferred to a bank account and used to cover various living expenses such as housing, food, healthcare, travel, and more. The beauty of this approach is that it does not necessitate the sale of any shares of stock. Dividend investing presents a straightforward solution for separating income from one's time, a crucial factor for retirement. The appeal of this strategy has grown over time, as witnessed by countless investors who have achieved financial independence through dividend investing. Since 2015, Simply Safe Dividends has been a strong advocate of dividend investing, offering online portfolio tracking tools and dividend safety scores. Our unwavering support for this approach has only intensified as we have observed the multitude of investors who have successfully pursued financial freedom using this income strategy. Now let's see deeper into the essential aspects of retiring on dividends. How a retired person can live off dividends. Living off dividends can be achieved by following a prudent investment strategy. The Wall Street Journal offers a practical example to illustrate how dividends can support a sustainable retirement. Suppose you retire with a $1 million portfolio and aim for an annual inflation-adjusted retirement income of $40,000, assuming a long-term inflation rate of 2%, treasury yields matching inflation, and stock dividends growing at 3.5% per year. Here is how it could work. Invest $400,000 in treasury bonds, which provide a stable income stream. The remaining $600,000 can be allocated to stocks yielding 3%, generating $18,000 in dividend income each year. After utilizing all the dividend income, you would need to sell a portion of the bond portfolio to meet your $40,000 inflation-adjusted annual income target. This strategy would lead to the depletion of the bond portfolio in approximately 21 years. However, during this period, your annual dividend income might have grown by about a third, reaching $24,000 per year after adjusting for inflation. The critical aspect is that you would still own all your stocks. If the dividend income grew by approximately 33% after accounting for inflation, it is reasonable to assume that the value of your stocks could have appreciated by a similar amount. This appreciation could result from the growing cash flow of the stocks, potentially reaching close to $800,000 in the value. Assuming you retire no earlier than age 60, by the time you reach your 80s, you would still have a substantial amount of funds left for the remainder of your retirement. The specific mix of stocks and bonds in your portfolio will depend on various personal factors. However, it is attainable to build a portfolio of quality dividend stocks collectively yielding 3% or higher and growing their dividends by at least 3.5% per year. The amount of dividend stock required to meet your financial needs will depend on several factors unique to your situation. It is essential to consider your desired income, expenses, portfolio size, investment goals, and risk tolerance when determining the appropriate allocation of dividend stocks. The next question arises that what would be the amount of money required to retire on dividends? To determine how much money you need to retire on dividends, a rough rule of thumb is to multiply to your desired annual dividend income by 22 and 28. This range provides an estimate of investment needed to generate a portfolio dividend yielding between 3.5% and 4.5%. By staying within this dividend yield range, it is possible to build a conservative dividend portfolio without compromising on business quality, income safety, or sector diversification. Additionally, such a portfolio can be expected to deliver mid-single-digit annual dividend growth over time. For instance, a study by the U.S. Bureau of Labor Statistics found that the average total annual expenditure for older households in 2014 amounted to $49,279, adjusted for inflation. This corresponds to approximately $62,000 in 2023. If dividends were the sole income source for this household, they would require a portfolio ranging from around $1.4 million, which is equal to $62,000 multiplied by 22, and $1.8 million, which is equal to $62,000 multiplied by 28, assuming a starting dividend yield between 3.5 and 4.5%. However, it is likely that this household has the other source of income, which would reduce the amount of dividends needed in retirement. But the key point is that how to build a dividend retirement portfolio. When starting a dividend retirement portfolio, you have the option to allocate your funds between individual stocks and funds. Dividend-paying mutual funds and ETFs offering advantages such as low fees, immediate diversification, and simplicity. These funds are typically set-it-and-forget investment, requiring less active management. Most funds own a large number of stocks, with some holding dozens, hundreds, or even thousands of companies. For example, Vanguard's High Dividend Yield ETF PYM has over 400 holdings. Within these funds, there will be a mix of high-quality business with safe dividends and low-quality companies that may face challenges during economic downturns. Some stocks may have high yields, while others generate minimal income. In essence, a fund comprises a blend of companies that may not align perfectly with your specific income needs and risk tolerance, especially during challenging market conditions. For instance, during the 2007 to 2009 financial crisis, Vanguard High Dividend Yield ETF faced difficulties because it lacked a focus on dividend safety. Its dividend income dropped by 25% during that period and took 4 years to recover to a new high. Additionally, most funds pay variable dividend that fluctuate unpredictably each period, making it challenging to forecast your monthly income accurately. While this doesn't mean you should avoid funds altogether, handpicking your own dividend stocks can offer benefits. It allows you to customize the risk level in your portfolio and provides better visibility into your income stream. Individual companies typically pay fixed dividend amounts on a quarterly or monthly basis. This means you will know precisely how much you will receive from each stock and when you can expect the payments. At the end, we will see some important guidelines to construct a dividend portfolio. When constructing a dividend portfolio, it is advisable to adhere to the following general guidelines. Number 1, diversify with 20 to 60 stocks. Holding a sufficient number of stocks helps mitigate the risk associated with the individual companies by diversifying your portfolio. You can avoid being overexposed to the performance of any single stock. Number 2, equal weight position. Allocate roughly equal weights to each position in your portfolio can be a prudent approach. It can be challenging to predict which company will be the best long-term performer, so maintaining an equal weight strategy ensures that no single stock dominates the portfolio performance. Limit exposure to a single sector. It is recommended to avoid allocating more than 25% of your portfolio to any one sector. By separating your investment across multiple sectors, you can reduce the impact of sector-specific risks and increase overall portfolio diversification. Number 4, focus on companies with safe or very safe dividend safety scores. When selecting dividend stocks, it is beneficial to target companies with strong dividend safety. Utilizing tools like dividend safety scores can help assess the likelihood of a company maintaining or increasing its dividend payments over time. Prioritizing companies with safe or very safe scores can provide added confidence in sustainability of your dividend income. By following these guidelines, you can build a well-diversified dividend portfolio that aims to reduce company-specific risk, maintain balanced exposure, and prioritize the safety of dividend payments. Thanks for watching. If you think it valuable, please don't forget to subscribe our channel.